Welcome to Griffonomics.
Glad to be here for this one. It's a wild story.
It really is. So imagine sitting on a guaranteed $16 billion in future cash. You'd probably be popping champagne, right?
Oh, absolutely. You'd think they already won the lottery?
Right. But what if, to actually unlock that money, you had to burn billions of dollars you don't even have, just laying track right in front of the speeding train?
And watching the biggest name in AI hardware suddenly dump your stock while you're doing it.
Exactly. So today we are looking at a company called Applied Digital, ticker symbol APLD. And for you listening, we're diving into how they are attempting one of the most aggressive structural pivots we've ever seen.
Yeah, they are basically trying to evolve from a legacy crypto mining host into, well, a designer and operator of gigawatt-scale AI infrastructure.
Which they call an AI factory, right?
Right, an AI factory. And it's an incredibly ambitious transition. We aren't just doing a post-mortem on their latest quarterly earnings here.
No, we are unpacking the actual physical and financial realities of trying to build the plumbing for the AI revolution.
Because having the fastest chips in the world means absolutely nothing if you don't have the real estate, the power, and, the cooling to actually plug them in.
So true. And that is the central tension for you as you listen to this deep dive.
Yeah.
How does a company secure $16 billion and a contracted backlog, yet face such intense market skepticism today?
It's a massive disconnect. And to answer that, I think we have to look at how they are actually making their money right now.
Yeah, let's start there.
Yeah.
Looking at the sources, their fiscal third quarter of 2026 top-line revenue hit $126.6 million.
Which is huge. That's up 139% year over year.
Right, but that revenue isn't coming from just one place. It's actually split across three distinct pillars.
Let's break those down. So starting with the Legacy Foundation, which is their data center hosting. This is their original business.
Just providing energized space for cryptocurrency miners, right? Like in places like North Dakota.
Exactly. And this segment, it really feels like the reliable cash cow. It generated $37.5 million in revenue and $13.9 million in operating profit just this quarter.
So it's sitting out in the pasture, quietly generating the steady cash that Applied Digital is using to fund the construction of their brand new rocket ship.
I love that analysis. And that rocket ship is the second pillar, which is high-performance compute, or HPC hosting.
Right.
This is the infrastructure purpose-built for artificial intelligence. It's their real growth engine, pulling in $71 million this quarter.
And that jump was mostly driven by their first 100-megawatt building coming fully online at their Polaris Forge 1 campus, right?
Yep, that was the catalyst.
Okay, let's slow down on that for a second because, high-performance compute, it just sounds like generic tech jargon.
Mm-hmm.
But physically, this is fundamentally different from a crypto mining facility, isn't it?
Oh, drastically different. I mean, crypto mining essentially just needs cheap electricity and massive industrial fans blowing air through a warehouse.
Right, it's pretty basic.
Exactly. But the new generation of AI chips, they run so incredibly hot that traditional air cooling physically cannot keep up. The silicon would literally melt.
Wow. Literally melt. So how do they handle it?
So HPC facilities require high-density, liquid-cooled space, and Applied Digital, they recognized this bottleneck early on.
Right.
They built one of the world's only fully operational 100-megawatt direct-to-chip liquid-cooled data centers.
So instead of blowing air, they are piping cold fluid directly over the processors.
Exactly, which gives them a massive technological moat. And then there's the third pillar, cloud services.
This is their GPU as a service platform, right? Essentially renting out the actual computing power to AI developers.
Yep. And that generated $18.1 million. But, reading through the sources, this three-pillar structure is actually already being ripped apart.
Wait, really? Why?
Well, Applied Digital realized that to fund the massive real estate expansion for these new AI factories, they had to separate the computing hardware, the GPUs, from the physical buildings.
Okay, so this is the strategic inflection point for the whole company, right? The Chronoscale spinoff.
That's the one. They're taking that third pillar, the cloud services unit, and merging it with a company called Bionics.
To form a dedicated, publicly traded AI infrastructure company called Chronoscale Corporation.
Exactly.
Okay, I'm going to stop you right there because when I read this in the sources, my brain just blue screened.
I know, it sounds crazy.
Bionics makes robotic exoskeletons. Why on earth is an AI cloud business merging with a medical bionics company? Those two things have absolutely zero overlap.
On an operational level, you're completely right. They have nothing to do with each other. But financially, this is a classic reverse merger shell game.
Okay, walk me through that.
So EK Soso is already a publicly traded company, right? And they've stated they are exploring strategic alternatives to offload their legacy bionics business entirely.
Mm.
So Applied Digital is simply using EKSO's existing corporate shell to slide their cloud unit onto the public markets.
So it just allows them to bypass the grueling, expensive, and lengthy roadshow process of a traditional IPO.
Precisely. It's a shortcut.
Okay, so UKSO is really just the Trojan horse to get Chronoscale listed. And the sources say Applied Digital will still retain about a 97% ownership stake in the combined company.
So they still pull the strings.
But help me understand the overarching strategy here for you know, the listener. Why spin off the GPUs at all?
It really comes down to asset lifespans. In the data center world, physical real estate, like the concrete slabs, the steel frames, the massive cooling pipes, those are 30-year assets.
Right, they last forever.
Exactly. But the GPUs, the actual computer chips humming inside those buildings, are fast appreciating assets. They become obsolete in, what, 3 to 4 years?
Yeah, the tech moves too fast.
Right. So if you keep both on the exact same balance sheet, the constant need to buy new chips drags down the valuation of your real estate.
Oh, I see.
By separating them, Chronoscale can raise its own specialized capital just to buy GPUs, leaving Applied Digital's balance sheet focused entirely on the physical infrastructure.
Which makes a lot of sense because building gigawatt-scale AI factories burns cash at a terrifying rate.
Terrifying is the right word.
Yeah, let's look at the financial realities here because the growth metrics are staggering. During just the first 9 months of fiscal year 2026, Applied Digital spent $1.59 billion in capital expenditures.
It's just a massive amount of money.
I actually did the math on that before we started. That is roughly $5.8 million a day going out the door.
Yeah, it's an immense burn rate. Now, to be fair, they aren't exactly running on fumes.
Yeah.
They are sitting on $2.1 billion in total cash, combining both unrestricted and restricted funds.
Sure, but against that cash, they are carrying a colossal $2.69 billion debt load.
Which is heavy, no doubt.
Very heavy. I mean, they recently priced a $2.35 billion senior secured note, offering just to fund the Polaris Forge 1 campus. And then they turned around and did another $2.15 billion offering for Polaris Forge 2.
Right. And to secure all this liquidity, the dilution for shareholders has been, frankly, severe.
Yeah, the sources show common shares outstanding skyrocketed from 224.9 million to over 285 million shares.
And that's not even counting the massive warrant issuances they've handed out to their anchor tenants.
It really feels like they are sprinting while laying track in front of the train.
The leverage is extreme, there's no denying that. But, and this is key, hyperscale data centers are uniquely punishing in their capital intensity.
How so?
Well, think about the timeline. You have to spend hundreds of millions just clearing land, pouring specialized foundations, and securing massive power transformers.
Oh, right, the infrastructure before the infrastructure.
Exactly. And by the way, those transformers alone have multi-year lead times right now. You are spending billions of dollars before a single server gets plugged in to generate 1 cent of revenue.
Wow, so it inherently forces any company entering the hyperscale arena into heavy debt and equity dilution during the build-out phase.
Yeah, it's the cost of entry.
And what's fascinating is that this daily $5.8 million burn isn't just buying generic warehouses. It's actively funding solutions to the two hardest physical constraints in the AI revolution.
Electricity and heat?
Exactly. Let's talk about their power strategy, specifically the base electron model. Because Applied Digital helped found an independent power producer, or IPP, called Base Electron.
Right, and their goal is to build a 1.2 gigawatt natural gas plant in the Dakotas.
So what's the catch there?
Well, the structuring here is very clever. Applied Digital isn't actually building or operating this power plant themselves.
They aren't.
No. Instead, they provided a limited credit guarantee to help Base Electron get the project off the ground. In return, Applied Digital shareholders get 10% equity in the power producer.
Okay.
And crucially, once Base Electron raises $50 million or goes public, that credit guarantee from Applied Digital completely terminates.
Wow, okay. So what's the tangible benefit for Applied Digital? Just that 10% equity?
No. The real prize is priority access to the power in front of the meter.
What does that mean exactly?
So a lot of data center operators try to build small private power plants directly on their own property. That's called behind the meter.
Right.
But doing that brings massive operational headaches. You have to maintain gas turbines, manage fuel supply chains, and deal with emissions regulations.
Sounds like a nightmare if you're a tech company.
It is. So by fostering an independent power producer that feeds directly into the regional utility grid, Applied Digital avoids managing a power plant while still securing a dedicated source of electrons.
Okay, I get it now. It's like paying to construct a dedicated fast-pass lane on the highway, but forcing someone else to deal with the toll booths and the pothole maintenance.
That is exactly what it is.
And that dedicated power feeds directly into their Polaris Forge model, which utilizes those modular, waterless, liquid-cooled designs we talked about earlier.
Yep, so they've secured the power and they've solved the heat.
Which brings us to the payoff. The $16 billion contracted backlog.
This is the anchor of their entire valuation right here. And we need to be clear for the listener, these aren't speculative projections or, handshake agreements.
These are signed long-term leases.
Yes.
So let's dissect who is actually signing these checks. First, CoreWeave accounts for about $11 billion of that backlog.
That's a massive chunk.
It really is. That covers 400 megawatts of capacity across multiple buildings at Polaris Forge 1. Then you have an unnamed U.S. investment-grade hyperscaler.
Right.
That's a $5 billion 15-year lease for 200 megawatts at the Polaris Forge 2 campus.
Plus the upside. That unnamed hyperscaler holds a right of first refusal, or ROFR, for an additional 800 megawatts.
800 megawatts, just to put that in perspective for you listening.
Yeah.
800 megawatts is enough electricity to power a medium-sized city.
Yeah, it's mind-boggling. And that represents the full 1 gigawatt expansion potential of the entire Polaris Forge 2 campus.
Okay, so I hear $16 billion in 15-year leases, but as an investor, a backlog is ultimately just ink on a page until the data center is built and the rent checks clear.
That is the big caveat.
Right. So what happens if the AI bubble pops? What happens if these hyperscale tenants overextend themselves and try to walk away from these leases? How ironclad is this paper?
That is the multi-billion-dollar question. And the answer lies in how they actually restructured the CoreWeave agreement.
Okay.
They moved this contract into a special purpose vehicle, an SPV, which recently secured an investment-grade A3 rating.
Okay, so an A3 rating means the debt is considered upper medium grade with very low credit risk.
Yeah.
But how did they get that rating for a single tenant?
By instituting a lockbox structure?
A lockbox.
Yeah, a lockbox is exactly what it sounds like. It's an independent bank account managed by a third-party trustee.
Okay, I follow.
When CoreWeave generates revenue from its AI cloud customers, that money goes directly into the lockbox. The trustee is legally obligated to pay Applied Digital's lease expenses first.
Oh, wow.
Yeah, Applied Digital is at the absolute top of the payment waterfall. CoreWeave's own executives can't even touch their profit until the data center rent is paid.
So even if CoreWeave struggles at the corporate level, the actual revenue generated by the specific GPU sitting in Applied Digital's building gets captured to pay the lease.
Exactly. Plus, the sources mentioned they secured a $50 million letter of credit and springing parent guarantees from CoreWeave itself.
So they've essentially built a contractual fortress around that revenue stream.
Precisely.
All right, let's step back and look at the whole picture then. The cooling tech is bleeding edge. They've insulated themselves from power grid constraints with base electron.
Right.
And the $16 billion backlog is fortified with A3-rated lockboxes. So if the setup is this flawless, why is the stock chart a roller coaster? Why is the market still showing such intense skepticism?
Because institutional investors, they always look at the concentration risks.
Ah, right.
Out of that $16 billion backlog, roughly $11 billion is tied to just one customer, CoreWeave.
That is a massive basket for
Right.
all those eggs.
Yeah. I mean, CoreWeave is an absolute juggernaut in the AI space today, but having nearly 70% of your future revenue dependent on the health of a single tenant is a structural vulnerability.
Yeah, markets will always discount that kind of concentration.
Always.
And then there's the Nvidia situation. This was a massive headline. In late 2025, Nvidia, the undisputed heavyweight champion of AI hardware, fully exited its position in Applied Digital.
Yep, they dumped all 7.7 million of their shares.
Right. If the infrastructure is so critical, why did the king of the industry completely walk away?
Well, the optics on that exit definitely fed the skepticism, but you have to look at NVIDIA's strategic motives here.
Okay.
NVIDIA originally invested in Applied Digital because they needed to guarantee that physical infrastructure was being built to house their next-generation chips.
Because if there's nowhere to plug the chips in, Nvidia can't sell them.
Exactly. But once Applied Digital proved they could successfully operate these liquid-cooled facilities, and they secured the billions in financing to finish construction, NVIDIA's strategic goal was accomplished.
Oh, so they didn't need to hold the stock anymore.
Right. They are a chip designer. They don't want to tie up their capital playing real estate landlord.
That makes a ton of sense.
Yeah,
They catalyzed the market and then took their money off the table.
exactly.
But there is also skepticism around their profitability reporting, right? The sources show they reported a GAAP net loss of $100.9 million for the quarter.
Yeah, it looks bad on paper.
But simultaneously, they claimed a positive $44.1 million in adjusted EBITDA. A $145 million swing between two accounting metrics is usually a massive red flag.
It looks alarming, but it ties directly back to the Chronoscale spinoff we discussed earlier.
Oh, it does?
Yeah, that $100.9 million gap loss was heavily skewed by a $59.7 million non-cash write-down.
Okay, walk me through how a non-cash write-down actually happens here.
It's pure accounting mechanics. Before the eKaso Bionics merger was finalized, Applied Digital had their cloud services unit classified on their books as an asset held for sale. But once they entered the definitive agreement for the reverse merger, accounting rules required them to reclassify that unit back to held and used.
And that triggers something.
Yeah, whenever you shift an asset between those categories, you are legally required to mark it to its current fair market value. That reclassification triggered the $59.7 million hit.
I see.
So it's a paper loss. It doesn't mean $60 million just vanished from their bank accounts.
Okay, so the gap loss is largely a technical anomaly. But even factoring that out, the customer concentration and the sheer scale of the debt leverage are legitimate reasons for institutions to hesitate.
Very legitimate.
Which leads us to the strategic outlook, the final verdict. What is the actual end game here?
Well, financial analysts currently rate Applied Digital as a high alpha infrastructure play.
High alpha meaning it has the potential to significantly outperform the broader market, right?
Right, but you have to be willing to stomach commensurately high volatility and risk. The management team's stated target is to surpass $1 billion in net operating income, or NOI, within 5 years.
$1 billion in NOI. Based on everything we've unpacked, hitting that target entirely hinges on two massive execution hurdles. Number one, timely construction.
Yep.
They have to physically finish building these massive gigawatt campuses on time and on budget without supply chain delays crushing them.
And number two, they have to fundamentally transition their debt structure. This is the absolute key to unlocking shareholder value.
Right, because right now they are funding construction with very expensive project finance loans.
Exactly. Those secured notes we talked about earlier carry interest rates north of 9%. That kind of debt will bleed your margins dry over the long term.
It's like putting the construction of a skyscraper on a high-interest credit card.
Pretty much.
So the whole game plan is to survive the chaotic building phase using those expensive credit cards, and then, the moment the data centers are operational and the tenants are paying rent, immediately refinance into a stable 30-year commercial mortgage.
That's exactly the mechanism. Once the buildings are finished and the lockbox revenue starts flowing, the risk profile of the entire asset drops dramatically.
Because lenders are no longer betting on construction execution. They are just collecting guaranteed rent.
Exactly. At that point, Applied Digital plans to refinance that expensive construction debt into cheaper asset-backed financing, or ABS.
And if they can secure standard commercial interest rates while maintaining those 15-year A3-rated lease revenues, their profit margins will expand exponentially.
Right.
So for you listening, the investment thesis really boils down to one simple question. Do you believe this management team can navigate the massive cash burn and supply chain nightmares to finish these campuses without letting the $2.6 billion debt load crush them before they reach the refinancing phase?
It's a race against their own balance sheet.
It really is. And as we wrap up this deep dive, I want to leave you with a final thought to mull over. We spent a lot of time digging into the weeds of reverse mergers, lockboxes, and liquid cooling.
A lot of weeds.
Yeah, but take a step back and look at the macro picture. As AI models grow exponentially larger, the power grids in this country are hitting their absolute physical limits.
Which is why that base electron deal is so critical.
Exactly. Look at what Applied Digital is doing there, securing dedicated power plants just to feed their servers. Will companies that manage to lock up regional power generation and fast-pass their access to the grid become the new, unregulated utility monopolies of the 21st century?
It's a fascinating question.
Because whoever controls the plug controls the AI.
It's a profound structural shift. We are watching the infrastructure of the next decade being built in real time.
Power is the ultimate bottleneck. Risk defined,
Hmm.
portfolio protected.